We're seeing big moves within financial markets at the moment, with equities lower, the US dollar lower, yields lower, and a lot of it is linked to inflation. And that's why Friday's Core PCE price index figure is going to be so crucial. There are signs of a resurgence in terms of manufacturing inflation in particular, just as we see services inflation move towards the downside. And certainly, given those fears, a potential resurgence in terms of the Core PCE price index could be hugely detrimental when it comes to market sentiment. So let's jump into it. Here's the expectations according to Trading Economics. Crucially, 0.4% expected on the monthly Core PCE price index figure. That's the highest number since January of 2024, so a 12-month high. And generally, we do see a spike in terms of inflation data for January. It's something we've seen for CPI, which I'll show you in a second. And it's expected to have that same effect for the PCE metric. In terms of the year-on-year figure, 2.7, so down from 2.8. So essentially, the monthly figure for this January is expected to be lower than the previous January. Here's that breakdown, and you can see it's a good thing that the Federal Reserve like to utilize the Core PCE price index figure rather than the Core CPI number, because Core CPI at 3.3, Core PCE at 2.8. We can see here in the middle section that the latest inflation figure on the CPI number, or the Core CPI, spiked higher. And we can see back at the previous January that we do generally see relatively elevated numbers in Januaries. And so we're expecting at this time around 0.4% expected, but we're not necessarily expecting to see a big bump higher in terms of the Core PCE figure. Crucially, if you look at that 2.28 figure on the bottom, that's the 6-month annualized figure, which essentially means that in 6 months' time, at the current pace, where should we be? And that is 2.3. So that would make us think that, we're in a good position to be able to see inflation return to target. But we've seen some warning signs, and certainly the PMI numbers provided exactly that. The manufacturing input and output prices both move sharply higher. Services either flatlining when it comes to the input prices or moving lower when it comes to the prices charged metric. Bear in mind, all of these numbers are above 50, so that still means there is an expansion. But certainly, services inflation looks to potentially pass over the baton to manufacturing inflation. And a lot of this comes around Donald Trump's tariffs. Now, some of those tariffs have been implemented. Some of those tariffs are yet to be implemented. There's an idea that next week we're going to see Canada and Mexico hit by tariffs. But just like last time where they delayed it by a month, it could be a ploy to get a better deal. Maybe they do implement it, but it's only short-term in nature. Who knows? But certainly at the moment, it feels like businesses are preempting those tariffs and adjusting accordingly. And so we're seeing this pop in terms of input and output prices for manufacturing in particular. And that's something to watch out for. In terms of the surveys for manufacturing, it's the same kind of thing. Now, we haven't necessarily seen a sharp rise in terms of the ISM manufacturing PMI prices paid metric, but we haven't seen the latest figure. And if you look at the latest figure for the Philly Fed and the Michigan one, it's the Empire State prices paid metrics for the manufacturing survey or sector, we can see both move sharply higher of late. Now, if you look in the past, we saw a pop in terms of these surveys, the prices paid elements, and then we saw a delayed rise in terms of core CPI, in terms of core PCE. So is this a precursor to us seeing that rise in terms of inflation? What this does show is that it takes time for it to feed into the economy, and so you might not necessarily see it immediately. If we're looking at the 6-month annualized change for some of these different sort of ways to look at inflation, different ways to break up the same data, what's notable here is pretty much every line on my chart here is moving upwards, apart from the core PCE figure, which we haven't got the latest number of. So this kind of points towards the core PCE number rising. Like I said, markets are actually expecting it to remain somewhat flat in terms of the annual figure, but this is the 6-month number. So certainly if we were to see this moving towards the upside, it starts to see the building of upside pressure here for the inflation figures across the board, whether it's the core CPI, the core PCE, the shelter component, which is absolutely key, the core stripping out the shelter, the services stripping out the shelter, and headline CPI. And crucially, that rise in terms of shelter is expected to be somewhat lagging in nature. So it's taken a long time to come back down, but it's massively influential in the calculations for CPI. And the fact that it's starting to move higher on the 6-month basis, it's a little bit of a warning sign. Like I said, we haven't necessarily seen a major uptick in terms of goods inflation. It's been a services-led problem, not a goods-led problem. And so do we start to see an uptick in terms of goods inflation? Well, as we saw previously, it can take a bit of time. Where are we looking at? It was this chart. So it takes a bit of time for things to feed through. Of course, these are 12-month changes, so you might see it on the sort of month-on-month measures nonetheless. Then let's talk about the implications for markets. Now, what we've seen recently is fears around stagflation, for one thing, and that means that you're looking at two different sides of the coin, right? So you're looking at growth and economic output. You're looking at the jobs, those kind of things. So, is the US economy healthy? And on the other side of it, you're looking at inflation. So are we seeing high or low inflation? What are the expectations? Unfortunately, at the moment, we have fears of both weak economic data coming out and higher inflation data coming out. The latest Michigan survey saw a 30-year high when it came to the 5-year inflation expectations figure, at the same time as us seeing the services PMI figure collapse back below the 50 threshold and pointed towards contraction for the services sector. So weak economics, but higher inflation. That is exactly the worst position to be in, because what you don't want is a weakening economy and inflation in a position where the Federal Reserve have their hands tied behind their back and they can't necessarily do much about it. What this chart shows you here is that the two-year swap for the euro area versus the US. So this is inflation expectations, but also it's tied up in terms of yields. So I could switch out these for, say, the 10-year yields. The relationship between those will also impact where euro dollar is. So you can see the differential between the two. So one minus the other gives us euro dollar essentially. So inflation expectations, yes, we have been seeing sort of higher inflation expectations recently, but do we see high inflation expectations when we're seeing weak economic data? Well, there's some question marks around that. So certainly if we're looking at the potential for a strong inflation metric when it comes to the core PCE figure, then you're looking at the possibility of an upside move in terms of, say, the two-year inflation expectation swap. If we see weakness, then it points in the opposite direction. In terms of where markets are sort of pricing things at the moment, the numbers that we have seen recently point us in the direction of a greater degree of rate cuts. So this is key to it, right? So if you're seeing a weakening economy, the weak services PMI and the like, we're seeing the conference board figures also coming out very weak. We're already seeing that weaker economic data. Do we see an inflation reading that continues to enable a greater degree of rate cuts? Well, at the moment, markets are pricing more rate cuts because a month ago compared to now, or even a week ago compared to now, a week ago you were close to 20% expectations that we see 0 rate cuts this year. Now we've seen pretty much all of that shift all the way over to the left-hand side of this image, where we're seeing the potential for 3 rate cuts or 4 rate cuts this year. Significant shift, and that's only over the course of a week, and it comes off the back of, in particular, that services PMI number, and now we're seeing that conference board figure, which is further reiterating that point. The weakness that we're seeing in terms of equity markets also play into this, because if we see weak equity markets, then markets think that the Federal Reserve are going to have to do something about it. So it all feeds into the narrative that the Federal Reserve are going to need to do something. But inflation, if we see a major resurgence in terms of inflation, it hampers that. So let's look at the likes of Eurodollar first and foremost. Here we go. In actual fact, let's look at, say, the 10-year yield, because then we can start to overlay things onto that so we can see the correlation between these markets. So here we go. So this is the 10-year yield, and you can see it's moving sharply lower. Now, that essentially is going to mimic the sort of two-year thing where we're looking at inflation expectations, but we're also looking at yields, economic activity, the outlook for interest rates, because the outlook for where the Fed funds rate is going to impact where the 10-year is going to be. And so we're moving sharply lower at the moment. That move is likely to be exacerbated if we do see weak inflation data coming out, because it points towards more rate cuts from the Federal Reserve, essentially. So weak inflation data points towards a weak 10-year yield, which points towards a weak US dollar, as we can see here, if we overlay it. There we go. So close correlation between the 10-year yield and the dollar index. And so if we're looking at the dollar index as a potential market that could suffer, or the US dollar, you have to try and pick your battles, right? Do you trade the dollar index, which is against a basket? Do you trade euro dollar, or against another currency? Today I'm looking at euro dollar. The reason being that I think the European area is actually quite well positioned at the moment. We're seeing equities in the region doing much better than US markets, but also we have the possibility of an end to the war in Russia. Whilst it doesn't look like the Europeans are absolutely desperate to sort of roll over and find an agreement that means that what was Ukraine is now owned by Russia, or in parts, an end to that war is a good thing for Europe in particular. We've seen a massive spike in terms of energy prices for many countries. The likes of Germany have been hugely reliant on imports of gas, in particular from Russia, and the spike in terms of the price of energy has been detrimental to German businesses. And you can see, if we look at the direction of travel for the German economy, it's pretty much been downwards the moment that war started. So if we find an agreement on that side of things, then that's a positive when it comes to the euro. And so if we're seeing the possibility of strength for the European sort of story coming at the time that we see the possibility of weakness for the US dollar, then we could be seeing a double bottom here. So you can see it here, a breakup through 105.329 points towards us reversing some of the downside that we've been seeing at the back end of last year. Now, remember, historically, Donald Trump, when he comes into power, if we look back at his previous stint as president, we see markets see it push into a strong dollar, and then it reverses. And last time around, we saw, as we can see here, so we saw strong dollar and he came into power, and now we're seeing a weaker dollar. And when he came into power last time, that weakness lasted for a year. So there's a good chance we could be bottoming out here for euro dollar. In particular, if we see a weaker inflation metric, then that would embolden markets most likely towards the upside for euro dollar. But like I said, we haven't actually broken out from this double bottom formation quite yet. We haven't completed it. Right now, we've come into the 61.8 fib, tapped it, moving towards the upside. A breakup through 105.329 sort of exits us out of this bottoming pattern and points towards further upside to come. But like I said, it really comes down to how inflation comes out. If we see a stronger than expected core PCE figure on Friday, it points towards a possibility of a stifling of the weakness in terms of the US dollar. But certainly the current trajectory when it comes to yields does point towards the possibility of that differential between euro yields and US yields narrowing further, which comes to the benefit of euro dollar. So a key one to be looking out for. And the other market that we want to be talking about is going to be the likes of US stocks. This is the S&P 500, but let's just look at exactly what it's doing at the moment. So we can see here that the S&P 500 is rolling over. It's playing out the same kind of correlation at the moment to the dollar, to the US 10-year yield. And I guess to some extent that's to be expected, in the sense of if you're seeing weakness in terms of the US dollar, is that an indication of how people perceive the US economy right now, and in which case the S&P 500 drops? But that's not always the case. Certainly a lot of the time you'll see the US dollar, here we go, you'll see the US dollar strengthening as the equity market weakens because of its haven role. So this relationship isn't always how it is at the moment, and it can chop and change as we move forward. if we look at the Dow Jones Industrial Average, this is an interesting one because it's actually outperformed its peers. If we compare that to, let's say, SPX, which is the S&P 500, and then Russell 2000, and then the US 100, which is the NASDAQ. We can see here that of late, if we look at, say, the last month, or let's look at the last week. There we go. It's all a bit choppy with some of these charts. There we go. Let's just look from the top and see what's faring best. So as you can see here, sort of Dow Jones Industrial Average from the peak are roughly around 3% lower. The S&P pretty similar to that. The Tech 100 or the NASDAQ down 5%. The Russell 2000 down almost 5.5%. So the Dow has been the outperformer of the bunch. And it's not necessarily too surprising because some of this weakness that we've been seeing has been kind of like specific names. It's not necessarily an entirely widespread sell-off that we're seeing. And therefore, the Dow has, sometimes that benefits the Dow. Sometimes it comes to the detriment of the Dow. If markets are rallying and it's got a name like NVIDIA, it didn't have NVIDIA in it for a long period of time. And the size of the moves in NVIDIA from going from $1 trillion company to a $3 trillion company meant that we saw the Dow lag. Now we're seeing it actually holding up relatively well because it doesn't have some of these names within it. And so we're pulling back at the moment. I think there's a good chance that this is a retracement. I mean, ultimately, if we're seeing some weak economic data, that weakness is likely to be a short-term phenomenon, right? So people are talking about strength for the economy under Trump. Well, the Doge movement that we're seeing at the moment is expected to be a good thing down the line. It means that the government doesn't have as much debt. But what does it mean for the economy right now? Well, more job losses. So there's a higher chance that we're going to see the jobs data coming out and showing a load of people unemployed because they're pushing people out of their jobs, right? But it's not necessarily a bad thing to see the government spending less because the government has huge debts. But for the near term, people are realizing that the data might be a little bit more troublesome. Of course, tariffs in the end can benefit the US if they manage to strike trade deals that mean there's more demand for their products. But it can also mean for the time being a tit-for-tat trade war, which is detrimental to these businesses. So if you look further out, I think it's positive, all of this stuff that's happening for the US economy. But there's some significant hurdles over the near term. The whole China thing is another issue in terms of chips and the trade between the two. But then Donald Trump has said that he'd be open to a potential trade deal that sees the Chinese buying a huge amount of US goods and investing in the country. So I think the end game isn't necessarily that he imposes all of these tariffs. I think the end game is that he uses tariffs to benefit the US economy and benefit US businesses. But for the time being, does point towards a potential for weakness. So this is the weekly time frame. It shows you that like we're within this, we've got a really hefty decline needed to get us back below this low that we have here. Let's just get onto a regular mode. So your swing low that we have down here is 41736, right? So as we sell off, you have to sort of think, are we going to break out from this bullish trend? For that to happen, from a wider perspective, you need to break the 41736. It provides a double top formation and points towards further weakness. Until that happens, there's a good chance that the sell-off we're seeing at the moment is a retracement. And does that mean we're not going to see any further downside? Well, no, not necessarily, because we're at 50%, could see further. Does look a little bit likely at the moment, considering the fact that we've seen this consolidation and starting to sell off once again. But, you just look at it on this sort of intraday basis and say, well, we've seen this consolidation with this triangle formation, the sell-off, retracement, sell-off, retracement, now breaking lower once again. Good chance that we do continue this decline, maybe get into your 43,000, which is 61.8, 42,500, which is your 76.4. Don't necessarily know exactly where this sell-off is going to end. But unless we break the 41736, then I think there is a good chance that this is a short-term phenomenon, and then we find the support soon enough. For us to start feeling bullish once again, though, instead of just blindly buying into it, you'd be looking out for a rally up through your prior swing highs. So just look out if we see a breakdown from here. Let's say we break down into the 61.8. Let's say we break down here and then we rally up through your 43745. Then for me, that would be my confirmation signal to say that the sell-off is over. You can look to get entry on fib levels and just presume that you're not necessarily going to break through this swing low, and then stops would be around that level. So different ways of playing it ultimately. But I think the Dow at the moment, it's been holding up a bit better than some of these others. I know markets are very fearful at the moment. But, you know, I think that it's short-term sort of hurdles, and people soon enough will remember that, you know, we're not entering a new sort of pandemic or something like that. You know, like there's certainly question marks around some of the valuations in tech. But do I think that tech bubble has burst and AI has burst? No, I don't. Yeah, maybe people reallocate into different stocks, but and then, you know, the whole tariff thing, yeah, there might be a bit of near-term pain, but it might ultimately mean that we get more rate cuts. It might bring down inflation ultimately, because if you look at the last time we implemented tariffs, we didn't necessarily see a huge amount of inflation. And at the moment, the inflation that we're seeing is sort of preemptive, I would say. A lot of businesses, I think, are trying to act ahead of potential tariffs. Anyway, look, you know, we certainly look bearish at the moment. There is a good chance we continue to weaken from here. But just bear in mind, we've got a very clear bullish trend in play at the moment. So unless we break the 41736, I think there is a good chance that this downside move that we're seeing is a retracement before the bulls come back in once again. So I hope that has been useful. I mean, we're seeing some big volatility in the markets, which is a good thing for all those volatility heads out there. We are seeing a shift in terms of market expectations in terms of the Fed's pathway for cuts. And ultimately, we are seeing, you know, significant moves lower for the likes of the US dollar. And that's certainly something that I've been pointing towards as being a theme that's likely to play out over the course of this year. I think dollar weakness is going to be a key theme, and that's continuing to play out. So big volatility right now, but it's not necessarily the end of the world. We're not at the beginning of another pandemic. And you have to always sort of cast your mind back. Generally, when we see really big sell-offs, it's when there's something drastically wrong with the economy. And I think, you know, short-term hurdles while they try to resolve these sort of tariff issues and things like that wouldn't necessarily be akin to a 2007, 2008 style financial crisis or a pandemic, or the massive boom in terms of inflation that we saw with the Ukraine-Russia war. It just isn't. And ultimately, the resolution of the Russia-Ukraine war might provide the basis for lower energy prices. And that could bring greater economic output in Europe, and it could bring down inflation as well. So it could be good, but we could see some hurdles in the meanwhile. Thanks a lot for joining me. Like, subscribe for more. My name is Josh Mahony, Chief Market Analyst here at Scope Markets. Thank you.